Gold just did something it hasn't done since 1979, and if history even rhymes here, what comes next is literally unthinkable. But scroll through social media right now and half the people are telling you gold is going to the moon, the other half are screaming bubble, so who do we believe? Here's my answer. Believe the charts, follow the money flows. I'm Raoul Pal. I spent 20 years at Goldman Sachs and GLG Partners watching institutional capital move before it hit the news, and I can tell you with certainty the news tells you what happened yesterday. The charts tell you what money is positioning for tomorrow, before the Iran strikes even hit mainstream news, before CNN. Before Fox, before anybody started yelling on TV, money was already flowing into gold. That's the smart money. That's institutional positioning. If you wait for the headlines, you're already late. And here's what most people are completely missing. Iran might not be the end. It might be the beginning. The next domino might be closer than anyone thinks. Subscribe to this channel. What I'm about to show you could change how you see the entire geopolitical landscape. Part 1. The 1979 parallel. To understand what's truly unthinkable about gold right now, you have to understand the pattern. 1979. The Iran Revolution. Oil shock hits. Panic spreads. Confidence collapses. And gold explodes. That year, gold went from roughly the low 200s to the high 800s, an insane move in a short period of time. That's the parallel everybody is missing. The chart structures right now are showing similarities to prior stress periods. Gold has broken out of what I call the heartbeat pattern, that tight, rhythmic compression you get before a major move. When did we actually start breaking out? Late August 2025, not right before the war, not when the headlines went viral. The institutional volume started expanding months before the news caught up. Gold has been on an absolute tear ever since, and it's now crossed $5,000 per ounce. This connects directly to my everything code framework. Global liquidity is the master variable, but geopolitical stress accelerates the flows into hard assets. When confidence in the system cracks, capital doesn't wait for permission. It moves. Part 2. Oil is the key. Here's what most people don't understand. Every major war in modern history ends up being decided by one thing: who controls the oil. This isn't conspiracy. This is documented history. And once you see the pattern, you can't unsee it. World War II. Germany was crushing the Allies in North Africa, fast, aggressive, unstoppable, until they ran out of fuel. Allied bombers systematically destroyed fuel production. By the end, planes existed but couldn't fly. Tanks were just metal boxes. Japan, they attacked when oil supply was threatened, pushed into Southeast Asia for fuel. When supply lines were disrupted, that was effectively the end. No oil, no empire. 1973 oil embargo. OPEC weaponized oil against the West. Supply tightened, prices spiked. What happened to gold? Surged dramatically over the next year. 1991 Gulf War. Oil spiked hard. Gold jumped quickly. Russia-Ukraine. Gold pushed through major levels and hit new highs. The pattern is consistent. Oil supply shock. Gold surges, often within months, sometimes within weeks, and right now. The Strait of Hormuz has disruption risk. Roughly 20% of global oil flows through there. Iran says it's blocked. The US says it isn't. Shipping insurers are repricing risk. Here's what matters. If insurance becomes unavailable or wildly expensive, shipping slows down even if the route is technically open. All it takes is a handful of drones, a couple of tankers damaged, one big headline, and suddenly oil isn't kind of volatile. It's violent. And when oil goes violent, gold doesn't sit politely and do nothing. Part 3. Why Cuba is next now. Here's where it gets unusual. Everyone is focused on Iran right now. But if you follow the money and you follow the oil, you can sometimes see the next domino before it falls, and the next domino might be Cuba. Let me unpack that carefully. Cuba has historically relied on oil flowing through networks tied to Venezuela. When US policy tightens around Venezuelan exports and the broader region gets squeezed, the knock-on effects hit places like Cuba: fuel shortages, blackouts, economic stress. It doesn't trend like a missile strike, but energy stress is a multiplier. Now think geography. Cuba sits 90 miles from Florida. It sits near strategic shipping lanes in the Caribbean and routes connected to Gulf of Mexico energy logistics. That is strategic geography. And if you've been paying attention to our history lesson, you know what happens when great powers start moving pieces around energy supply and strategic routes. I'm not saying I have a crystal ball. I'm saying if you follow the evidence, the money flows, the shipping routes, the insurance pricing, you can see where risk is rising. Before it becomes everyone's headline, shipping disruption risk shows up in pricing first. Insurance costs rise. Capital rotates out of exposed assets. Risk gets repriced before the average person even knows what to Google. Iran isn't necessarily the end. It could be the beginning of a broader repricing of geopolitical risk. Part 4. The Everything Code and Gold. Let me connect this to the macro framework. The Everything Code says global liquidity drives asset prices, but there's a corollary. When confidence in the monetary system cracks, liquidity flows into hard assets that exist outside the paper system. Right now we have $38.5 trillion in US national debt, $1 plus trillion in annual interest payments, a Fed that's arithmetically trapped, China moving $1.2 trillion out of treasuries. Central banks buying gold at record pace to simultaneous wars in the same geopolitical arc, the 11% hurdle rate, the 8% debasement plus 3% inflation you need to overcome just to maintain purchasing power is about to become the 15% or 20% hurdle rate if energy shocks push inflation higher, and here's the key. Insight: the Fed cannot raise rates to fight inflation without triggering a debt service crisis. The Fed cannot print money to fund deficits without accelerating debasement. There is no clean exit. Gold knows this. Bitcoin knows this. The smart money knows this. That's why gold crossed $5,000. That's why central banks are accumulating. That's why the chart broke out before the headlines. Part 5. The 3 phases of geopolitical shocks. Let me give you the framework for navigating this. Markets move through 3 phases during geopolitical shocks. Phase 1. The shock phase. Headlines explode. Volatility spikes. People panic sell. Oil and gold surge. The market drops. Everyone says, "Why me?" This is the emotional phase, and it's where most retail investors do the wrong thing. They either panic sell or chase the spike. Neither is intelligent. Phase 2. The absorption phase. Things start to stabilize. The market digests the news. Safe havens often keep working, but you start seeing rotation underneath. This is where retail investors usually do the worst thing. They sell after the damage is done because they finally can't take it anymore. That's why you need rules, because without rules, your emotions become your strategy, and your emotions are not a good portfolio manager. Phase 3. The recovery phase. Typically months into a shock, money starts rotating out of pure defensives and back into growth. The smart money repositions before the average person feels safe again. This is where retail gets trapped, still stuck in safe havens because they're traumatized. Then safe havens cool off, they feel betrayed, sell those, rotate into growth after it's already recovered. Classic buy high, sell low loop. Part 6. The DFU framework. Here's how to actually navigate this. DFU: don't F this up. Rule number 1. Watch the charts, not the news. There is no investment edge in knowing the exact coordinates of where a missile landed. There is no edge in doom scrolling casualty counts. There is no edge in being emotionally flooded. The news is designed to get clicks. It's designed to make you feel. It's designed to scare you, enrage you, and keep you glued. It is not designed to help you build wealth. Gold moved earlier. Gold broke out when the money moved, not when the headlines told you why. I don't own a television. I haven't watched the news in years. Not because I live in a cave, because it doesn't help. It makes you more distracted, more emotional, and more likely to do the exact wrong thing at the exact wrong time. Rule number 2. Follow the money flows. When money flows into gold, that tells you something. When money flows into energy, that tells you something. When money flows into defense, that tells you something. You don't need a prophecy. You need a process. Rule number 3. When a headline makes you want to act, pause. One of my mentors taught me, if you're excited, do nothing. If you're scared, do nothing. Sleep on it. The urge to act immediately is usually the urge to make a mistake. The difference between winners and losers isn't that winners see the future. The difference is winners have rules. Rule number 4. Position for multiple scenarios. The unthinkable isn't that gold could go higher. Charts can support lots of scenarios. The unthinkable is that most people will sabotage themselves right in front of the opportunity. They'll watch the news, panic, react late, buy tops, sell bottoms, and then tell themselves the market is rigged when the real issue is they never had a framework. Part 7. Where the money flows. Let me show you the recurring safe haven rotations during these periods, not as a prediction, as a pattern. Gold and gold miners. Physical demand tightens. Uncertainty rises. Central banks are meaningful participants. Miners are higher beta, they move more. Silver. Monetary-ish, but also industrial. Modern military tech uses silver: drones, guidance systems, communications, electrical contacts, and the physical supply is tight. Energy majors. When supply disruption risk rises, cash flows for energy companies benefit. That's why money rotates there. Bitcoin. This is where my thesis gets interesting. Bitcoin is evolving from risk asset to digital hard asset, mathematical scarcity, institutional adoption, currency debasement hedge. In a world where the monetary system is restructuring, Bitcoin is the new entrant to the safe haven category. The 11% hurdle rate demands assets that can beat debasement. Gold has done it for 5,000 years. Bitcoin is doing it over the last 15 years with 50 annualized returns. Let me tell you what the unthinkable actually is. It's not that gold could surge like 1979. That's thinkable. The charts support it. It's not that Cuba could be next after Iran. That's thinkable if you follow the energy flows. The unthinkable is this. Most people will watch this unfold and do nothing intelligent about it. They'll consume news instead of studying flows. They'll react instead of positioning. They'll let emotions override rules. They'll buy the top, sell the bottom, and blame the system. And the opportunity will pass them by. The pattern is clear. Oil shock, gold surges, geopolitical stress, hard assets outperform currency debasement. Scarce assets in 1973 proved it, 1979 proved it, 1991 proved it, 2022 proved it, 2026 is proving it right now. The money has already moved, the charts already broke out, the institutions already positioned. The only question is whether you'll be on the right side of the trade or whether you'll be the exit liquidity for someone who followed the money while you followed the news. The magic is out there, but you have to see it to capture it. Don't F this up.